In this video, we will talk about an important topic that will regularly and easily bring you profit every week. We will talk about gaps and how to monetize them. But before that, I want to remind you that we have the Otis Alpha channel, a community where you can receive the most relevant and profitable setups in the market. We trade intraday positions and scalping positions with high quality entry points, take profit targets and stop losses. Just yesterday, literally within the day, we took positions like CFX, WIF pump. And as you can see, during the day, these positions brought us excellent profit. WIF delivered 1500% in literally just a couple of hours. So if you're in this market solely for profit, then why you are still not with us? We trade together and take profits from this market, link in the description. Well, let's move on to our topic. A gap is a price difference between the Friday close and Monday open. It occurs because big capital leaves for the weekend and the market remains in the hands of retail. Low liquidity equals cheap manipulation and untrue price movements. Here is our CME chart, for example. You see, this is Bitcoin on Chicago exchange, and here is our price gap. Let's mark it like this. What does it look like? You see, this is the price gap where previous price action closes before the weekend. Nothing happened during the weekend and the price movement begins on Monday. And this movement is filled, either partially or completely. Only small traders and degans remain in the market at the moment. No volume, no resistance from professional participants. The price flies anywhere easily. Manipulation happens. But these movements are usually have no way and are often compensated on Monday. Hence the main principle. On weekends, we do not enter the market, especially without experience. Why does the price return to close the gap? A gap is an untraded zone, essentially an imbalance of interest among large players. There are two reasons why the price returns to cover these inefficiencies. Number one, unfilled orders of large participants placed here during the price movement. The price did not pick up these participants and their limit orders. The price returns to activate these orders, triggers them, and continues its upwards movement. Second, self-fulfilling behavior. All traders know about these gaps, trade toward their closure, and thereby force the price to go there. Let's also look at examples from previous history. Here we had a price decline. First of all, here it's a gap that, as you can see, is also filled. Then price action continues. We got selling volume. The counter volume is so strong that a gap appears. The price still returns to this gap, fills the limit orders here, and continues its movement, thereby forming a new gap, which, after interacting with liquidity below, the price also fills with participants' orders and continues its movement. In simple words, the logic is extremely simple. If we have a price gap, the price closed at one level on Friday and opened at another level on Monday, during the new trading session, then we have a price gap. And if the gap appears below, then we can safely look for short scalp positions toward this price gap, because the price fills it with 95% probability. Also, if a price gap appears above and at the moment of the trading session opening, the price is below this gap, we can safely open our scalp long positions with targets up to this gap, because the price will aim to fill this price difference. This way we can easily monetize it. At least every week these price gaps occur as long as weekends exist on the Chicago Futures Exchange. You can find many of them and backtest them on your chart. You see price action is moving. A long movement. Here we have Friday. The price on Friday closed here, forming our price gap. Here we have limit orders of our participants, large market participants. During the weekend, the price made manipulation, then returned, filled the orders of the large participants, and continued further the true market movement. Accordingly, this strategy can be traded every week as long as the Chicago Exchange does not operate on weekends and works from Monday to Friday. This schedule works and we can use it and monetize it. A gap is not a signal, but only an additional argument. It is not an instrument with 100% accuracy, but historically gaps close in about 95% of cases always, meaning all movements that occur over the weekend, all manipulations are compensated on Monday with 95% probability. The weekend opening is almost always compensated. So where do you look for gaps? Gaps must be checked on CME Futures. How to find them? You need to type in your trading view search in the asset section BTC1 exclamation mark. Same for Ethereum, we need ETH1 exclamation mark. Accordingly, we switch to the Ethereum futures chart. Here we also look for gaps and price differences that occurred during the weekend. Here is our price gap, which is also gets filled. Let's mark it. Even if the price goes further up, manipulation happens, then consolidation. We know for sure that at the opening of the trading week, we can, for example, open short because the price will always return to fill our gap. From this gap, we can get counter volume for buying. Here is another example. We have Friday, October 24, a formed gap. The price went further and we remember that with a 95% probability our gaps always get filled. Here, at the first appearance of selling volume, we can open our short position to fill this gap and take such profitable trades every week. Again, a gap is not a signal, it's pure logic of large players' behavior. You must understand where big capital was on Friday, which means you understand where the price is aiming on Monday. Thank you for watching, all useful links are in the description below, be sure to watch the previous helpful educational videos.